Welcome to Robinhood Stock Market Watchlist Zoom meeting / training. We do this every weekend. My name is Carlos. I'm the creator and administrator of our Facebook group where we do this every week. This is live, so with some of our members here, some of you guys are new. This is your first time here. Some of you guys have been joining this session every week for maybe the last several weeks. But one of the things that we like to do is to always kind of go over the basics, no matter what, that way, we're always, it's like an exercising, we're always exercising to make sure that we're always on top of our game. And so we always have to understand, what type of traders there are and everything. So there's several different types of investors. You have your long-term investor, you have your short-term investor, you have your then you have your swing traders, day traders. We got options, we got cryptocurrency, we got all sorts of different types of things that we can invest in or to trade. And so but there's one thing that they all have in common that we all use is something called moving averages. Moving averages is one of the most important tools that we really need to master, that helps provide us our buying and selling signals. It is like our assistant. It is one of the most important things, like I said, that we need to constantly use no matter what, unlike being new where, you don't really know that you were just kind of throwing money at something and hope it sticks. And that's what I call using the hope system, because you're trying to be optimistic and you're hoping that it works out. And sometimes you may get lucky, especially if it's during the summertime, maybe springtime, but it doesn't always pan out. So we need consistency, and that's one of the things that we'll be talking about, is how can we maintain gains day after day, week after week, month after week, and year after year, because the stock market has different algorithms, and different strategies don't always work. So we have to know, our capabilities and how to utilize all of them. And so, but as I had mentioned, moving averages is one of the most important things that we need to use that helps us tremendously. And I have a couple of videos that I'll pull up here that are only a couple minutes long. And then what we'll do is I'll show you in the Webull desktop application how to configure your moving averages accordingly to your style and strategy. So let me pull that up here really quick.
The moving average is one of the most commonly used technical indicators. If you've spent even a little time looking at price charts, you will have noticed that most often the price of an instrument will move up and down. In fast-moving markets, you may find that the price may be surging up only to plummet moments later before surging up again, increasing the potential for false signals. The moving average can help filter out the noise from random price movements and smooth it out in order to see the average value. Moving averages are used to identify trends and confirm reversals. When the price is above the moving average line, we consider the instrument to be in an uptrend. Conversely, if the price is below the moving average line, we consider it to be in a downtrend. The breaking of the moving average line usually implies a trend reversal. Moving averages are also used to identify areas of support and resistance. Many traders will consider the moving average line as a support and resistance level indicator and base trades on it. So traders will check to see whether the price is going towards the moving average and see whether it will bounce back from it or break it, as with regular support and resistance level. Oftentimes, the price of an instrument will find support at the moving average line when the trend is up, and will find resistance at the moving average line when the trend is down. So moving averages will tell you whether an instrument is trending up, down, or if it's ranging. It can tell you if a trend is still in motion and whether it is reversing or losing momentum. Have in mind that a moving average is based on past prices and is known as a lagging indicator. Therefore, it will not warn you in advance, but it will confirm when a trend change has taken place. At the most basic level, when the price crosses up and over the moving average, traders take this as a signal to buy. When it crosses down under the moving average line, they consider it a signal to sell. Let's take a look at the types of moving averages. There are three main types: simple, weighted, and exponential. We will discuss the simple moving average, or SMA, first and show you how it's calculated so that you can adjust it according to the given market circumstance. So if you wanted to plot a 10-day simple moving average, you would add the closing prices of the last 10 days and divide by 10. This calculation gives equal weight to each day. It's called a moving average as the oldest price is dropped each time a new period becomes available, in this way ensuring that the average is based only on the last X number of periods, in our example for the last 10 days. Have in mind that the longer the simple moving average period, the more it lags and the slower it is to react to the most recent price movement. And this brings us to its downside. As equal weight is given to all periods considered in the calculation, the simple moving average is slower to respond to rapid price changes that might prove to be important. So how can you counter this? With another type of moving average, either a weighted or an exponential moving average. The weighted and exponential moving averages are calculated differently from one another, but both types give more weight to recent periods and thus more emphasis on what traders are doing at the moment. So as a result, weighted and exponential moving averages respond faster to price action by distributing more weight to recent periods and less to older periods. They reflect a quicker shift in sentiment, which can be due to changes in supply and demand or important news events that impact the traded instrument. To illustrate what we mean, if you were to plot an exponential moving average and a simple moving average on a chart, you will see that the exponential moving average is closer to the current price than the simple moving average. Apart from the type of moving average, you also have to decide on the time period. This will largely depend on the type of trend you are analyzing. Here are some guidelines for commonly used time periods: 10 to 20 for short-term trends, 50 for mid-term, and 200 for long-term trends are typically used. When and how should you use moving averages? Deciding which moving average to use and the time period will depend largely on your objective. Use exponential moving averages for shorter time frames, or if you're analyzing a fast-moving market, as you'd have more emphasis on the latest prices. Use simple moving averages if you are planning on holding a position for a longer period of time, as the exponential moving average might be too sensitive and give false signals. You should also use simple moving averages if you'd just like to filter out the noise from random price fluctuations to determine the overall market direction. Thank you for watching this tutorial on moving averages.
Okay, so we're going to switch over to Webull. We'll take a look at some moving averages there, but also how to configure it for your style in investing. Now, I was just kind of looking at Shiba. Shiba is a cryptocurrency. Now, when I had discovered moving averages many years ago, I wanted to master it, just like anything else in the stock market. Anytime, we always got to learn something new. The more we learn, the more we're going to earn. And so when I discovered moving averages, I wanted to master it. I wanted to keep practicing because practice makes perfect. But when the stock market is open, I felt like that it was like the Super Bowl. You don't want to practice when it's game time. How do you practice moving averages when the stock market is open? So I discovered the best way to practice moving averages was to trade cryptocurrency. It's available 24/7 in most states in the United States, and there's no restrictions for the dollar amount that you buy or sell, and there's no limitations on how many times you can buy and sell. And so it was a great time. So Shiba, which was just right around 34 over here, just earlier today, just quickly kind of surged up quite a bit. And you can see that this was kind of the buying signal where the price line is above the moving average lines, and then the sell signal is the opposite, where the price line cuts through all the moving average lines, and especially when the moving average lines crosses over each other. We don't know how long it's going to keep going that direction until it provides us another signal. Just like right here, it's kind of providing us another buy signal, but it could also fumble a little bit, provide another sell signal. The MACD on the bottom is another chart that is often used alongside of the moving average, because a lot of times these can help provide us signals as well. Most of the time it provides us a signal prematurely, a little sooner. And so, but the MACD graph on the bottom here are two moving average lines, one's slower, one's faster. And then these colored bars are the gap distance between the two moving average lines. Lets you know if one is up or down, and you can see the gap bars either starting to lose their momentum and going the other way. You can see right here where it changed its trending direction, which was right up here a little early. So it basically said, you know, you might want to be careful and watch, because it could end up going down, and it did. And when you're looking at stocks like over here, a lot of times these graphs will show the volume bars on the bottom. And so you'll see the red and green. Red is obviously a majority of selling activity, where the green is the majority of buying activity. And then the length of the colored bars are the volume amount. So the lower the volume the bar is, the lower the volume. The higher the bar is, the higher the volume is for that particular time. Depends on the graph that you have selected. Right now we have it on a daily graph, so each bar, each notch is 1 day versus a minute. This is where you can go to see your 1 minute activity. And so but to adjust the moving averages accordingly to your style. Now, I specialize in day trading and swing trading. So the graph that I use is EMA for the exponential moving average, because it is more reactive with price changes, giving me more of a notice to react to the price change. Now, if you're a long-term investor, you're not going to want that. You're going to want a much smoother algorithm, a much smoother movement with the moving averages, because you don't want very many buying and selling signals when you're a long-term trader. And so but to change that, all you have to do, now again, this is Webull, but there's a lot of different other applications that you can use, but they're very similar. If you're using Robinhood only, Robinhood is a great application, but it still lacks a lot of very valuable tools. So you want to use a couple different applications alongside with Robinhood. So I use Webull, which is a very highly rated application in your app store. Plus, it's a desktop application you can download, which is very powerful. But whether you're using the application or the desktop, you just click on your moving average indicator there, and then that'll pop up. Click on the little gearbox icon right there, then your indicator settings will appear. And this is where you can change your main chart to whatever that you like. And most investors are going to use either the regular moving average, or like I said, if you're more of a day trader, swing trader, you're going to want to use the EMA. Now over here in the lengths, we have 5, 10, 20, 30, 60, and 120. These are by default because they're most common, most popular. These represent trading days or time. You know, if you're on a 1 minute chart, it would be 5 minutes average, moving average price. We have 10 minutes, 20 minutes. But if you're looking at it by day, this would be a 5-day moving average or 1 week. The next one would be a 10-day moving average or 2 weeks. And then the next one would be 20-day moving average or 4 weeks or 1 month moving average. Now, if you're a more of a long-term trader, you're going to want probably either the 20, 30, and 60 or the 30, 60, and 120. Or if you're more of the day trader, swing trader, you're going to want probably the 5, 10, 20 or the 10, 20, 30. Now, if we click on style on the top, this is where we can choose which ones that we want to use. And we can modify the color to your preference for either style, or if you're colorblind, you can change the color accordingly to what works best for you. And so this is where, again, where we can really change the overall indications, because now it's not going to provide as many buying and selling signals. Let's change it again one more time here. Let's go 30, 60, 120. And now you can see that the lines are, the moving average lines don't really cross over each other that often. So it's pretty much in an uptrend. And so that's kind of what a long-term investor is going to want to see. They're going to want to see exactly what we're seeing right here. Now, a lot of times you'll see people using candles. So if I right click on it, you can see the line style. Most of the time you'll see people using candles. I don't use candles because it's very fuzzy. I like to see a very clear picture. The colored bars still represent volume information, which is still exactly the same on the bottom. So I don't need to repeat the same information. I need clarity. I need to see exactly what's going on. So the barred lines is exactly what I need to see. So that is the gist of moving averages. We're going to go into the second video, and we'll answer any questions that you may have here. Give me one moment while I load that up for you.
We will now build on material covered in the first tutorial on moving averages, where we defined what a moving average is, the 3 types of moving averages, and how they are calculated. In this second tutorial, we will discuss how to use moving averages to identify the direction of a trend, how they can be used to enter and exit a trade, and finally, how to trade moving average crossovers. To determine the direction of a trend using a moving average, you must take into account the set time period. We touched on this briefly in the last video, where we showed you the most commonly used time periods when analyzing short-term, mid-term and long-term trends. But why is it important to be aware of the time period of the moving average? In this chart, when we place a 20-period simple moving average by clicking the indicator icon and setting the time period to 20, we can clearly see that it indicates an uptrend. Yet when we place a 60-period simple moving average in the same way, we see that it shows the price in a range with no clear upward or downward trend. The difference in the direction of the trend portrayed by the moving average is due to the time period. Shorter period moving averages are faster at generating signals, and changes in the price of the instrument will be reflected more quickly. The longer period moving average will react to price changes much more slowly, but will generally provide more reliable trading signals. As a trader, moving averages will help you decide which way to trade by looking at whether the price is above or below the moving average line. In this chart, the price is above the moving average line and acts as support. You could buy and enter a long position when the price pulls back to the moving average line. You could then place your stop loss underneath the moving average. Here we can see the opposite. The price is below the moving average and acts as resistance. You could then enter a sell order when the price retraces to the moving average line and place your stop loss above the moving average. The interesting thing about moving averages is that they can be used alone or in combination with other moving averages. So when you place 2 moving averages on one chart with different periods reflecting a short-term and a longer-term trend in price, you have the opportunity to trade moving average crossovers. They can be used to determine when a trend has changed direction. Let's show you what we mean. On a daily chart for the pound US dollar, we will now place a 10-period simple moving average and a 20-period simple moving average. When a shorter period moving average crosses above a longer period moving average, it can signal that the trend is changing direction to the upside and it may be a good time to buy. When a shorter period moving average crosses below a longer period moving average, this is considered bearish, a signal that the trend may be changing towards the downside and it may be a good time to sell. No matter which 2 time periods you use, this principle will remain the same. To recap, a moving average is a lagging indicator that can help filter out the noise from random price movements to see the average value. It can help identify the trend direction, determine support and resistance levels, and can help confirm a trend reversal when looking at moving average crossovers. It is important to understand the differences between the types of moving averages and how to tailor the time period to best fit the trend being followed in order to gain the maximum benefit from this indicator. Thank you for watching this tutorial on moving averages.
Okay, we're back here. Let's switch back over to Webull really quick. We'll take a look at some things here. Let's pull up SPY here. Let me change my indicator setting back to my style here. And somebody in our group wanted to take a look at the RSI indicator. So the RSI indicator is basically a momentum oscillator that measures the speed and change of the price movement. So that's basically what it is right here on the bottom. Not a whole lot of people use it, but if it's basically it's 0 to 100 right here. If it's on the top here, that means it's pretty high, and the price is going to come down, which is basically kind of where it's at right now. Now the MACD again is the two moving average lines. They're just one slower than the other, and then you have the colored bars, which represent the gap distance. And so so the MACD looks like it may go up a little bit, which I would anticipate for the first half of this week should be pretty bullish, but towards the end of the week it's gonna be very bearish. So we can kind of can't see it really well on here, but we kind of have either a double top pattern forming here, or it could possibly be a head and shoulders, which is probably what I think it might be. Is going Monday, Tuesday, I think SPY will be up a little higher on the second tip, then it'll come down, and then the third tip will be just as high as this one, and then I think we're really going to enter the bearish season, and then SPY will come down quite a bit, and then for the next probably a couple months, and then come back up as we right before the spring season. But does anybody have any questions regarding moving averages before we go on to the next thing? We're going to talk about patterns. That is our next step, because patterns really helps provide us a lot of good information on what the stock price is mostly going to do next. But for now, does moving averages make sense to everybody? Anybody have any questions? You can feel free to unmute, you can voice talk, or you can chat in the chat room.
Yeah, Carlos, it's Joe here. I had a question. So I know one of the patterns that we're going to look at here in a second is like a fake breakout. So let's say it's trending above the EMA, but could that be seen as a potential fake breakout, or should we just ride the uptrend because it's above the EMA? We know it's going to continue.
Well, we really want to follow the system, and as long as it's above the moving average lines, we need to try to ride it as much as we can until, but also to kind of monitor the volume to kind of see what people are doing. But ultimately, these are our primary signals, and if it starts to go below the moving average lines, our last signal is when the moving average lines crosses over each other. That's our final and last signal. And so that is when we really need to, because it's going to keep going that direction until further notice. And so just like this, where the price line crosses over each other, the MACD provided us a little warning prematurely, and then as the price line begins to cross over all three lines, we kind of sometimes have to look at these. The reason why I use the three moving average lines is because they have like a risk factor. So the first moving average line, let's say the price line is above all three moving average lines. If it crosses over the first moving average line, that basically means that that there's a 75% chance it's just going to bounce right off of it and it's going to keep going up. But that means that there's a 25% chance it's going to keep going down. Once it crosses over the second moving average line, then that means it's a 50-50. There's a 50% chance it's going to keep going down and a 50% chance it'll just bounce right off of it and keep going up. Once it touches the third average line going down, that means there's a 75% chance it's going to keep going down and a 25% chance it'll bounce off and go up. But once the moving average lines crosses over each other, that's almost, it's definitely going to keep going,
That's your clear sign. Okay.
Yeah, that's the clear sign. That's the last signal. If you're still holding after that, that's on you. It told you so, and you could have easily did something about it. And the MACD warned you way beforehand. So we just have to, it's like sign language or a new language. We just have to understand.
And then let me interrupt, that lower volume at the end of that green portion of the MACD, that's like, all right, volume is slowing up. We're about to see maybe some selling.
Well, the volume's right here. So we have to, really focus on that as well to see, are people buying, are they selling, are they holding off? Because these low bars, they're pretty small, but then we're starting to see a lot of selling right here, quite a bit, like 2 days in one. And then we have a lot of people buying, and then we have a big cluster of a lot of people buying right in here. And this is a daily graph, so this is Friday, Thursday, Wednesday, Tuesday, Monday, and but we can see that it really started to trend up. But that could be because maybe it's forming a pattern, which is what I believe in. I believe this is either going to be a double top pattern or it's going to be the head and shoulders pattern. So I think Monday and Tuesday, it'll probably come up to 175, 180 for SPY or whatever, and then it'll fall down and then come up and then keep going down for the next month or so. But that it's really, really critical that, based on your style and investing, that you just set everything up accordingly. But this is out of a majority of professional investors and traders, this is exactly their setup, that they'll use the moving averages alongside with the MACD. So, practice makes perfect. Be sure that you practice this stuff, and because it's only going to make you better. The more you learn, the more you're going to earn. And eventually you're going to be trading, $1,000, or you're going to be gaining $1,000 a day. It's going to come up to $10,000 a day, and it's going to be more. So, this is very, very valuable information. Anybody else have any more questions? Everything makes sense?
Hey Carlos, this is Adil. Regarding the MACD, the same graph, if you go to the left a little bit, you will see it turned from red to green, but just little bit, and start to go back to red again. However, if you check the moving average, there is a buy signal over up. No, go to the left. Left.
Here?
Yeah. To the red one before. Little bit before. No, to the left. Yeah, here, right here. There is a buy
right?
signal. Yeah, right here.
Right here, yeah.
No, to the right, to the red dip, just before that one.
To the left?
Yes. Go left. Yeah, right here. So there's a buy signal over here. So once you buy, it's just continue to green little bit, and just it followed by a bigger dip. Yeah, if you start from here and follow the moving average, and if you go up, it will not continue a little bit, and it will immediately goes down again.
Yes. Now this isn't. I mean, it is a buy signal in an uptrend way, because it's not because the original buy signal looked like it was kind of down here when it really dipped below, and the moving average lines crosses over each other. It looks like they almost kind of touched here, but never crossed over each other. But when a stock is uptrending and you feel you're late, but you want to get in, you definitely don't want to get in when it's at a very high point. So the best time, just like what the video said, is if you're going to buy something that's uptrending, you have to buy it when it's touching the moving average lines. That's like your support and your resistance level. So if it is above the moving average line, that's your resistance. If it's below the moving average line, that's your support. So those are the times you want to buy on the dip when it's uptrending. and you don't want to miss the boat, and you feel that you're late, or vice versa. If you're holding and it's downtrending and you forgot to sell or whatever, you want to do the opposite. You want to try to sell when it then reaches and touches the moving average lines, because then that's your resistance, and that's when you're but when you're into stock options, now things get really interesting, because now we can bet against the stock by buying a put, and now a sell signal becomes our buying signal. We can now buy we can buy a call here, we can sell the call, buy a put, and then the buying signal, our normal buying signal, would be the signal to sell the put and then buy the call. So now things can get really, really interesting as we now master moving averages. We can play both sides. We can play bearish and bullish. And it can be very, very interesting. It can be very, very profitable, and which we'll get more into that here in just a little bit. But let's get into patterns here. I'm going to pull up a little cheat sheet. I'm going to pull it up here. Give me a moment while that loads for some reason. There we go. Pull that up. Yeah, patterns are extremely important to know and to identify, just like moving averages. But as we're looking at the price line and stuff, we have to imagine like a little square box around the price line, because we may be able to identify a pattern. And I highly recommend printing this out, and I'll post this in our group, in our chat room and stuff, that way you can download it. But I recommend looking at it daily, because out of sight, out of mind. If you're not looking at it, you're not going to retain it, you're not going to remember it. And so once you identify something, you'll be like, oh, I think there might be a pattern here. You'll kind of compare it, just like we did with SPY. It could possibly be the double top or the head and shoulders, because right now we're like right here. If it's a double top, SPY went up and then went down, and then we're either right here, and so, or we could be right here if it's the head and shoulders, and for the next Monday, Tuesday could come up here, and then the rest of the week right back down here. And then next week, Monday, Tuesday could be up here, and then as we enter the holiday, then it could go all the way down. Now, these patterns are going to be either bearish or bullish patterns. Now, some people always ask, why is there a target down? Because we can bet against the stock. If we know that this price is going to go down, we have what's called the entry. This is the area we want to buy and bet against this thing. And so where the stop is our stop loss, or it could be an invalid strategy in case if something happened with the stock market or that particular stock. Maybe the stock market's being manipulated or whatever. But most of the time, the stock price always goes towards its intended direction. But every once in a while, like I said, something could manipulate the whole system and cause everything to go off course. In that case, this is our stop loss if you're already in, or it's an invalid. So if you're not already in, abort and re-strategize in something else. But but most of the time, you want to enter right around the neckline. As long as you're confirmed that this is the double top pattern, you want to start buying puts on this thing. As it gets to the target area, the target is where you want to sell. Secure your gains, get in, get out, and repeat the process. Now, just because it reaches the target area doesn't mean that it's going to stay there. It can easily bounce right off there, form a new algorithm and pattern, and it could be completely something else. But that's when we want to go off of our moving averages, because this thing could keep going down. We don't know for how long or for how far, but once it changes its trending direction, your moving averages is going to do the crossover, and it's going to provide you your sell signal. And so, but a lot of times we'll see a lot of these patterns during the morning, not so much during the daily graphs, but we can find them on the daily graphs. But a lot of times we'll find these throughout the day using a 1 minute graph or even a 5 minute graph. So a lot of times, like early in the morning, especially if things are really positive, like the bullish pennant, where the stock market opens up and it shoots up for maybe 5 minutes, and then it kind of starts to zigzag down a little bit for the next 10 15 minutes, and then towards the end of the little funnel, which they call the pennant, is when it then begins to surge up. But we have to really be careful of the angles of the lines, because sometimes it could be something, it could be between a couple different things, like the bullish pennant or the symmetrical triangle, because these bilateral patterns could be either or. It could either be bullish or it could be bearish. So you really have to really compare the angles of the lines. But if you do identify, maybe it is a symmetrical triangle, because a lot of times you'll see these on penny stocks, or even a stock that has maybe beat their earnings and revenue, or whatever the news may be. The stock surges quickly right up, then kind of plunges down a little bit, gaps halfway down, and then zigzags really quick for some time. Towards the end of the little funnel here, it's going to pick a direction. So it's either going to go up or it's going to go down, but whatever direction it picks, that's the direction it's going to keep going. So now it's time to ride the wave. Your moving average provides you your signal when to get in, when to get out, and that's it. And you just keep repeating the process over and over and over again. And that's the professional way to trade and to invest. It's just you have to adjust your moving averages and your charts accordingly to your style and investment, because you may have a lot of time to be very active in this stuff, but a lot of you may not. A lot of you are working a 9-to-5 job or whatever, and you're not able to really focus on the stocks. So you may have to do more swing trading or short-term investing. And so that's where you want to focus more on the daily graphs, not so much the 1 minute and the 5 minute charts. But either way, this information is highly critical, but can only be really applied if we kind of set a good amount of rules that cannot be broken. Now, each investor and trader must set their own personal set of rules, because everybody's different. Everybody specializes in different things. But I do want to pull up a good set of rules that we'll use as an example. These are day trading rules, but they're very similar to a lot of other types of investors and traders. So
excuse me, Carlos. Yeah. Before we move into the rules, can you please go back to the earlier slide with regards to triangles and patterns? For some reason, my mind is unable to figure out these triangles in real stocks. So can you pull up any stock and show how it looks like, or how to imagine these?
Yeah, let's do that. And let me pull up Webull here really quick. And so here is SPY. We'll use that one as an example. And I think I remember another one here, but let me pull up. So again, it's best to try to imagine a square box around the price line. You may have to draw it if possible, but you can really easily imagine it. Now, this is SPY. So SPY, just like the graph, the patterns chart, the price goes up and it bounces back down here. So this could be the neckline. We don't know. It still could be premature, but we have to kind of think ahead. But also, we have to know what's going to happen ahead of time, which we'll get into here pretty soon. But by knowing the events that are going to happen here in the near future, they're going to provide bearish characteristics. So it'll only make sense that with what's planned ahead, that the stock will most likely come down to probably about here, and if not down even further, because then so later this week, this Friday is Triple Witching Day, which is going to be the most bearish day of this month, if not this quarter. And then next week is a holiday week, which anytime there's a holiday week in the stock market, usually we'll have the Christmas day will be off, and then but there's a lot of low volume. A lot of people, investors and Wall Street, they're going to be on vacation or or mentally or whatever, and so there's just a lot of low volume. So there's just a lot of bearish characteristics. So this next 2 weeks are just going to be pretty interesting. But by knowing that, and with the patterns, we can really tell what pattern this will most likely be, and it's either most likely going to be the double top or the head and shoulders. And so, and you can really kind of compare it, and it's really looking like that. What's another good one? Was it Peloton? No, not Peloton. Moderna? No. Hold on here. I'm trying to remember. If anybody can think of anything that has a pattern, let me know. So I'm trying to remember. There was a good one. AMD. Yeah, once we start looking at a lot of these stocks, a lot of them are providing a sell signal using the daily graphs. DocuSign. Yeah, I'm not seeing any really recent patterns in anything other than SPY. Let me keep looking now. Yeah, it's a lot harder to find patterns.
What about
daily
Lucid?
Lucid?
Over the past month. Lucid, possibly?
I think there was just a double top on Palantir. I think I just saw a double top on Palantir.
Let's take a look here. Double top. Okay.
Kind of in the center.
Well, right here is a double top pattern. You know, if we go looking at the past, let's go drawings, triangle, right here to there. It always looks like it reminds me of like the Batman or whatever. So the double top, just like what we're talking about with SPY, how the price comes up, kind of comes down, comes up, you know, this is kind of the same point that we're at. And it basically, you know, as it's kind of starting to fumble around here, it'll kind of hesitate that day, but you can see the moving averages had provide you a sell signal saying to get out or to buy a put, bet against this thing, because, you know, the stock price is going to come down. Just like I said, it doesn't know how long or how far that'll go down until it provides you a sell signal, which it looks like the moving average lines crossed over each other right down here it looks like it's 3 months apart. So, but that is definitely a double top pattern. Let's see if there was anything on Lucid. Lucid, kind of a double top there, but not seeing anything fresh for Lucid other than a recent sell signal. Looks like the MACD provided a sell signal for Lucid in November 30th, but the crossover was around July 7th. But the MACD basically said, get out, get out, get out. Moving average lines, I'm falling. So we just got to be able to really understand this language and be able to identify what it's telling us. And the patterns will come along with it. And so, but this is the number one thing. Patterns is number two. Let's see. Is there something? No, Rivian's too fresh. Robinhood, no. Yeah, I cannot remember.
Would you say Apple's going to be head and shoulder or no?
No, Apple right now hasn't really provided a pattern yet. It could provide a bullish pennant pattern. It's a little early, but a bullish pennant pattern is where it gradually comes up, then it'll zigzag down below here into a little funnel, and then it'll pop back up. Now, Morgan Stanley did provide a price target of $200. And so it could easily form that bullish pennant pattern and then boom, pop right back up to that $200 very easily. It's just, I think for the next couple weeks, it's going to see some growing pains going through triple witching and the holidays. And then after that, well, even that, after that's the New Year's. So the next 3 weeks is going to be very, very interesting. And but Apple is very, very strong. You know, out of everything, it is the most popular, most commonly day traded stock because the algorithm is very, very smooth. It's very predictable, especially with stock options. Every 1% Apple moves is like a 50% gain or 50% loss. Now, I highly recommend, especially going towards the end of the year, to straddle both calls and puts. Now, a lot of you probably don't know what straddling is, but A call is betting the stock goes up. A put is betting against the stock, betting it goes down. Now you can only lose what you put into one side, but your gains on the other side are potentially unlimited. So if you lose, let's say 90% on one side, but you just gain 300 or 400% on the other side, what did you really lose? Nothing. You gained a lot, a crazy amount. You know, sometimes if you think about this, if you have a 401k, your 401k only moves what, like 2-3% a month. So and you know, or maybe 10% or 15% a year or whatever. But I mean, if you can gain 100% in one day, but by straddling, I mean, especially with Apple, you know, there's no reason to really find any other stock or do anything else when you can do this. And straddling, I've learned this from a professional trader from within our group many years ago. He said all he ever does is buy calls and puts 5 minutes before close, and then he sells them within 5 or 10 minutes after opening. You know, he does that over and over and over, and it's considered swing trading. So you have unlimited ability to do that, and it doesn't matter whether the stock surges up or plunges down, you'll profit either way. So that way you don't have to rely on luck or hope or anything. You know, we can, and then we don't always have to buy the calls and the puts at the same time. We can buy them at different times, maximizing our gains and minimizing our losses. And so, but we'll get more into that here in a little bit. Well, let's go back to the patterns really quick. So again, these are the patterns, but there's one more pattern that's not on this list that we need to talk about for sure, is the dead bouncing cat pattern, which I'm going to pull up here just in just a moment. This is very common. It's very good to know, because the dead bouncing cat pattern happens very often, on a daily basis almost, where a stock price can react to some kind of news. It could be bad earnings, or maybe it's good earnings and the stock still plunges, or maybe it's a drug company that's been trying to develop some kind of cancer treatment drug for the last several years, and they've had some pretty good success, but then all of a sudden the FDA or the US government says that they're not going to approve it because it only has like a 72% success rate, and they need to do better. Well, all of a sudden the stock price reacts to whatever news that it may be, and the stock price plunges down however much. It could be 5%, 10%, 20%, 50%, 80%. But then the stock price bounces off of that, and it could bounce a little bit, or it could be quite a bit, usually up to halfway. And then the stock begins to lose its momentum and starts to begin to fall. Once it begins to fall right around this same original point there, that means it's pretty much going to fall the rest of the day. If it does that, you know, again, bad news can be great news. It just depends on how you utilize it. We can bet against this thing, buy puts, and then ride that wave all the way down and watch for your indicators to provide you when to sell your put. But if you happen to buy a share or a call when it's doing this, because maybe you feel optimistic and maybe you can profit from it, and you can easily still profit if you buy, you know, accordingly to the signals and then sell. But if you don't sell when it tells you to sell and it goes down, this could be catastrophic. And so it's important that we maintain certain rules, especially with stop losses, which we'll get into next when it comes to rules. I'm going to pull the rules back up here, because every trader and investor must have some set of rules that they must never break, because this will help maintain consistent gains. But unless you break them, then that's when mistakes can happen. So rule number one: always have some kind of limit on volume. You know, don't look for something that only has like 100,000 in daily average volume, because it's not getting any attention. It's not volatile. It's not, you know, unless you really have some kind of insider information of something, you know, really going to happen, rather than, you know, rumors or hype or whatever. But we need actual activity. We need volatility, because otherwise we're not going to profit very well. We're just sitting on time. but 1 million is good, is a good limit, if not maybe more, maybe 10 million average volume. But always have a certain limit on price, no less than a certain amount. Now my preference would not be anything under $1. I would usually go for at least $5 or more. But usually if it's a stock that's under $1, the stock is in violation of Wall Street stock market rules, because to be listed in the stock market system, they're supposed to maintain a stock value of at least $1 or more. If they're under $1, then they could be at jeopardy of getting delisted, or they may have to buy time by either doing a reverse split or filing for an extension until the company can figure something out to increase their share value. If the stock gets delisted and you're still holding, you're going to lose 50% a day until you sell. And so I highly recommend to avoid stocks that are under $1 to prevent that from happening. Unless you're day trading it, you're getting in and out, that's fine. But yeah, I do not recommend holding anything under $1. Also look for things that are priced, has a percentage change, as it's, if you're looking at a daily graph and the stock has gone up maybe 5%, or 10%, it could keep going, but you just have to look at the moving averages and to make sure that it is a fresh buying signal. Rule number 2 says day trade only, no swing trading. The reason why that's a rule in this, rules of day trading is because day traders can identify how the day is looking. They can plan, or they can really strategize by watching and waiting for certain algorithms, the moving averages and patterns. That way they can get in and get out. Kind of reminds me of a sniper. The sniper is out, out of sight and is very patiently waiting for the right time. And then as soon as they see the target, boom, they pull the trigger. And so that's what you got to be. We are stock market ninjas. We're like snipers. We got to use the system and to utilize it for our benefit. So rule number 3, trade stocks with news, press release, etc. Or even stocks that are going to have news. Things that may be flying under the radar, and something's going to happen. You got to remember that the pros have this old saying: buy on rumor, sell on news. So we got to make sure that we're really participating in stocks that are going to be very, very active. And that leads to rule number 4, volume of the day, but also trade stocks that have a high market capital, and like Apple or Tesla, Facebook, Microsoft, Disney, and so on. Because they just have a much smoother algorithm versus a penny stock. A penny stock can surge straight up, but it can plunge straight down. The algorithms of the moving averages are a lot more difficult than it is a high market cap stock. Rule number 5, enter at midpoint of support and resistance, which is what we were talking about when it comes to the moving averages. And then rule number 6, always use a limit buy and a limit sell. If you're buying shares, most of the time the applications are using a market buy and a market sell, but you want to do the limit buy and a limit sell, because if you're doing a market buy, you're telling the system to buy at any price, even if it's at a higher price than you anticipated. If you do a market sell, you're telling the system to sell at any price, even if it's at a lower price than you anticipated. Now, if you do a limit buy, you're telling the system to buy at your particular price or lower, whichever is in your favor. If you do a limit sell, you're telling the system to sell at your particular price or higher, whichever is in your favor. The only disadvantage to doing this is that if you do a limit buy, or if you send out your limit buy order, the price may have passed your price, and so then it's going to sit there and it may never execute. Or if you do a limit sell, and if it may not execute because now the price may have passed that and got lower, and now you're just sitting on there and waiting for it to execute. Now, then you have to go in there, you got to replace it, you got to modify it, or you got to cancel it and start over. Now, the best way to try to avoid that is when you do a limit buy, change the price to maybe a couple pennies higher. Or if you're doing a limit sell, sell it for a couple pennies lower. And this will this will prevent that issue from happening, and most likely the order will execute immediately, because when you are configuring your order and sending it out, it could take you a couple seconds, it could take you 5 seconds, 10 seconds, 20 seconds. It takes time to put in your settings and send the order out. And during that time, the price is still moving. It's not waiting on you, it's still moving. And so when we change our limit buy price or limit sell price, we need to make sure we're buying it for a little higher, selling it for a little lower, just to make just to account for that price change, just in case. Doesn't mean that it's actually going to sell it at that price or to buy it at that price. It's just in case if the price quickly changed by the time you send the order out. So that way you're not having to go in, because otherwise if you don't do that and if it changes, you're chasing the price. Now you're having to buy it at a higher price than before, or you're having to sell it at a lower price than before because you're trying to fumble with it. You're trying to chase it. You don't want to do that. You want to avoid that. So rule number 7, ABCD pattern, always enter at the C point. I'm going to show you what that means. I'm going to pull up a new image here that really explains ABCD pattern, enter at the C point. So this is the ABCD pattern. No matter what it is throughout the day, where typically this is a daily thing. So the stock market opens up, whether the stocks are down or they're up. Typically, the stocks will kind of, people start buying, start pumping the stock up. So usually after the first 15 minutes, the stock price breaks out and sets an intraday high. We're right here from opening. Opening is right here. We're here 15 minutes. Then after 15 minutes, the stock pulls back and sets an intraday low point. That's right here. So this is usually about 30 minutes between opening and right here at the B point. The stock begins to kind of come up a little bit and then begins to come down. And that's where the stock sets at a higher low and begins to turn. So it also provided us a pattern, like a bullish pennant pattern right here. And it's been 1 hour between opening and the C point. And now not only has it provided us a bullish pennant pattern, but the moving averages also provide us a fresh buy signal, because now the stock is going to go towards its intended direction for the day. And so the first hour and the last hour of every day is very volatile. So part of the rules is what it's saying is to wait, get that volatility out of the way. Now you can still trade during that volatile moment, but it just requires a little bit more experience, a little bit more knowledge, and everything. But for the most safest play, it's saying to wait 1 hour, enter at the C point until we can identify what's going on with the day. And normally at this point in time, most of the economic reports have already been released, and we know whether if they're going to provide bullish characteristics or bearish characteristics. Now, with whatever that it is, if it's bearish characteristics, then the stock's going to go down the majority of the day. We can start buying puts, or sell our calls, or sell your share, or whatever is going on. You'll know what to do based off of what's going on. We just got to put all the pieces of the puzzles together. All the stars have to align. But this is what that means. ABCD pattern, enter at the C point. Let's go back to the rules. We'll finish those really quick. So that was rule number 7. Now, rule number 8, it says sell 50% of your position at a target goal. That's not really a rule for day traders. Day traders get in, and then they get all the way out. They don't leave anything behind. But I do see that a lot of long-term investors will leave things behind, where they'll invest a certain amount into something, and then once it gets to a certain point, they sell the certain dollar amount that they originally put in there. So whatever shares are left, they look at that as like free money, and they'll just sit on it. Rule number 9, it says beware of the false breakouts, sell right below the support level. Now, we talked about the false breakouts and stuff, and how to prevent that is by configuring your moving average settings accordingly to your style in trading and investing. That way it's not providing too many buying and selling signals, especially if you're a long-term or short-term investors. You want fewer buying and selling signals, because otherwise you would consider that as a false breakout or false signal. rule number 10, it says cut losses at a certain point, whether you're down 2% or 5%, have something there. Don't be that person who's down 50% or even 70% saying, should I sell? Ride winners, let's see here. Ride winners, at least 10% or more, until it provides you your time to sell. And so just, have this in mind. This is just really, really important to have. But also something that to go along with it is the differences between an amateur trader and a professional trader. Knowing the difference between these two is like knowing the difference between right and wrong. As we grew up as kids, we're taught this by our parents, but we don't have anybody really to explain this to us, because most of us don't know anybody really that is into stocks. So we have to teach ourselves. And so this is the difference between an amateur trader and a professional trader, which is the difference between right and wrong. So this way you can identify whether you're doing something right or doing something wrong, that we can avoid these mistakes. So an amateur trader will let losers run and hope they turn around. There's that word hope again. That is, we do not want to rely on the hope system. Hope system is also part of your emotions, where you're feeling that you're optimistic about it, and that you hope that it'll no. Stick with the process. That is the moving averages, the patterns. That is our system that we need to go by off of. Where professional traders will cut losers when a stop is reached and a trade idea is invalid. Now we know what a stop loss looks like, or we talked about that, or what a strategy looks like when it becomes invalid. We know now when to get in, we know when to get out. And amateur traders close their winners too early because of fear of giving back profits. Maybe they got beat up a little bit last week, and now they got something that's giving them some profits, and they fear that it's going to go down, and maybe it does a little bit, and they sell because they sold too early, and then boom, then the stock goes up. Well, the stock was probably providing them the bullish pennant pattern, and they got really scared because it was going in that little end of the funnel thing. Well, they didn't know that about these patterns, so they figured that it was going to go down, and as soon as they sold, the stock surges up, and then they're like, why did I do that? You don't want to be that person. So where professional traders will let their winners run until a profit order or a clear signs are given to exit. Trust their system. The system is moving averages and patterns. So we have to master it. The more we learn, the more we'll earn. Amateur traders change their trading system after a few losing trades, because maybe they were trying something and they thought it worked, but now all of a sudden it doesn't. They're constantly changing stuff. No, the moving averages and patterns work consistently every day, every week, every month, year after year. That is something that we have to stick with, because professional traders will stick to these rules religiously, or whatever rules that they have set up highly religiously, and think process oriented. The stock market is like a battlefield. It is warfare. We have to look at this as a strategic plan, because there's so much manipulation, whether it's from a CEO or from a politician or from another country. China will manipulate a lot of stuff all the time that affects our markets, and somehow we're all kind of connected, and they're all in cahoots with each other. But we have to identify that and stick with these rules and think process oriented, because it's just going to continue our gains. Amateur traders will close their trades and never look at them, and avoid a learning effect. A lot of times you'll see these that'll post on social media, hey, I got $1,000, what should I invest in? Because they're not learning anything. They're just hoping that they can find something somebody can tell them and to invest in, because they're just there's just a lot of people that are that way, and those are the ones that should really focus on the long-term stocks. But where a professional trader will analyze their past performance, maybe even from others, and keep a trading journal and learn from their past behaviors, as well as learn from others. That way they're not making mistakes. And so an amateur trader will sometimes even overtrade or revenge trade and hope to make a lot of money fast. Now, there's nothing wrong with making a lot of money fast. We just got to do it the right way, and definitely not by using the hope system or revenge trade, which comes from emotion. Emotion can really affect your buying and selling decision tremendously, and you do not want to buy anything on emotion or sell anything on emotion. Professional traders are aware of their emotional impacts and know how to identify and manage their impulsive decisions. As long as you can stay focused on moving averages and patterns, and just think statistically and analytically, it'll help avoid your emotional impacts. Amateur traders open their trading platform and then desperately try to find random trade entries, where a professional trader will keep a trading plan and plan their trading day ahead, follow a structured approach. And so one of the key things as we're going into this next phase of our meeting is, how do we plan ahead? And one of the important things by doing that is by knowing what's going to happen every day for the next week, or if not 2 weeks, and how that will affect the stock market. And for the longest time, I've always wondered that, and just really started to follow the news because, one of the other things professional traders say is follow the money. And so when I started to realize or see the entire market would surge or the entire market would plunge, I was like, how in the world does that happen? How can everything go in the same direction at the same time? But I had learned that it is mostly affected by our economic reports. And so if things are affected mostly by our economic reports during that day, it is only just as important to know more about these economic reports. So, and it took me a little while to figure out, what places, what websites and resources that I can find this information at. And then I discovered an application and a website called investing.com. It is a very highly valuable free website that can give us a lot of news alerts and information, but a lot of useful tools. But for now, the economic report is highly critical as we begin to plan our week ahead. So on the website, I'll click on the top where it says Economic Calendar. If you download the application from your app store, you can download it to your tablet or your mobile phone. But we can, if you start utilizing it on your phone, there's a calendar app, part on the bottom, the middle area. You'll want to click on that, and the calendar will give you information on the economic calendar, earnings, dividends, and whatnot. But you want to select economic calendar if you're not there already. So what we need to do first is to clear everything off the economic calendar. We need to really pinpoint two things. So after we clear everything, we click clear. It clears all the check marks. There's only two things that we need to see. We need to put a check mark under the United States, and then under importance we have 1 star, 2 stars, and 3 stars. We want to put a check mark in 3 stars because we want to see every economic report that'll have the biggest impact on our entire stock market system for the United States. So then click apply. We'll scroll back to the top, and then we'll click this week. So this is everything that's scheduled to have a big impact on the entire stock market system, not just a segment, but the entire system is either going to go up or it's going to go down. So we can see that there's nothing scheduled for Monday, for tomorrow, that will have a big impact on the stock market. But going into Monday is basically, it's going to either be news from the weekend, from whatever, or it's up to us investors to really start pumping things up in Wall Street. So usually Monday, as long as there isn't any major terrible news, which I haven't really seen anything other than the tornado and whatnot, but that's not going to cause any it's not going to cause the massive dip in the stock market. In fact, it'll probably cause Home Depot to surge. But Monday, as investors get back from the weekend, they're eager to start investing and trading. So usually that is a good bullish characteristic. So, but Monday is to be determined, but most likely it should provide some bullish characteristics for Monday. And then Tuesday, we have the PPI month-over-month report. Now, if you're not sure exactly what this is or what it means, feel free to click on it, and a new tab will appear, and it'll tell you what it is and how it will affect the stock market. Now, the PPI, or the Producer Price Index, measures the change in the price of goods sold by manufacturers. It is a leading indicator of consumer price inflation, which accounts for the majority of overall inflation. Now, a lot of people may think, or a lot of new investors may think, that inflation could be a bad thing because prices go up. But when you look at it as an economic state of mind, it provides more profit for the companies. If the companies are more profitable, the shares become more valuable. So a higher than expected reading should be taken as a positive or bullish for the US dollar or the stock market, while a lower than expected reading should be taken as a negative or bearish for the US dollar. Now, we were getting some news last week about the inflation being really high. So that is kind of an indication or a clue that most likely this will probably meet or beat the forecast, because the previous report was up for last month of October 0.6%, and they're saying it is forecast to be the same, when last week they were saying it was higher. But so as long as it can meet or beat these two, it's going to provide some very nice bullish characteristics. Now, when we're looking at the time on these, very important, it's important that we know the time difference based on our time zone, because when we're looking at on the website, because I'm in the Seattle region, so I'm in the Pacific time. So, but when I'm looking at this on the website, this is Eastern time. So I have to know with my time zone and their time zone and everything, blah blah blah. But overall, this report is scheduled to be released 1 hour before the stock market opens. So if a lot of investors highly anticipate that this is going to meet or beat the forecast anyways, the pre-market is going to be very bullish. It's going to be very green. Once this report comes out, or right before the report, we'll see maybe a little dive, a little dip or whatever, but the report will come out, and we have to just kind of, just wait, because then the report's going to show up here in the actual part. So we definitely want to visit this page or the application on a daily basis, because this information changes. Plus, the government can add in other meetings or economic reports, or we could see maybe the president's going to talk, about something or other, and so all of a sudden a new schedule appears. So that's why it's really important. Or maybe there's no forecast yet. Like the crude oil inventory levels, there's no forecast, but most likely, the government will put something in there tomorrow. But they could change a lot of this stuff. So it's just good to really know, what's going on and to plan ahead. So with Tuesday, looks really, really good. So I'm thinking Monday should be pretty green, very bullish. Tuesday looks like it could be pretty bullish, but going into Wednesday, now we have the core retail sales and regular retail sales, where if we click on it again, it'll explain what this is and what it means and how it'll affect the stock market. After a while, when you are doing this regularly, you'll just know this. You don't even have to click on it, you'll just know it. Now, there are weekly economic reports, there are monthly economic reports, there are quarterly economic reports, and there are yearly economic reports. The yearly, the more longer these reports are from each other, the more volatile that it can provide the stock market. So as we go into the first quarter of going into next month, then that's when the yearly economic reports come out, and those are typically very bearish characteristics, because for some reason Wall Street investors do not like yearly economic reports. So after we get out of the first quarter, going into the second quarter, which is the springtime, that's when we'll see the transition of bearish characteristics back to bullish characteristics. Until we get closer to the summertime, then we're in full bullish mode. So it's just a normal algorithm that we get year after year. So it's just good to know if you're new investors. So going back to the economic report, so these two retail economic reports are also scheduled to be released at 8:30 at Eastern time, which is 1 hour before the stock market opens. So these reports are going to affect the pre-market. And then at 10:30 on Wednesday, which is 1 hour after the stock market opens, that's when the crude oil inventory levels come out. Now, some of these economic reports, we need them to be lower, like unemployment, crude oil inventories. These reports need to be lower because the lower they are, that means it's better for the economy. And so if crude oil inventory levels are down, that means people are driving, they're either going on vacation, they're traveling, they're spending money, they're doing whatever. It's just good. You know, if they're not down and they're actually going up, and if oil inventories are up, that means people are not driving, they're not spending money. That's not good for the economy. So most economic reports, they need to be up. Now, before we get into the closing hour on Wednesday, we're going to see a massive amount of volatility, and it could be very bearish characteristics, because we have a lot of this FOMC stuff. These are where the government starts talking about economic projections. They could typically say something that could spook investors, and they'll sell. If they start selling this, then the market is going to plunge, especially when they start talking about interest rates decisions. Now, the government's going to start increasing interest rates probably as early as next month. This is going to create, the stocks are going to start plunging because people are not going to be buying as much. They're not going to be buying cars. They're not going to be buying homes because they're doing that now. They're trying to secure their low interest rate now before the government starts increasing them. And so going into next year, as the interest rates start going up, this is going to be the season for banks. Bank of America, Wells Fargo, and so on, and so Chase, and so on. You know, this year is the banks are going to shine because now they're going to start making money and revenue on interest as the government starts increasing them. So, but that's not so. You know, it's just a weird transition. You know, we're going to see tech stocks go down, retail sales are going to go down, or retail type of stocks are going to go down, banks are going to go up. So we're going to see this weird transition, but just be ready. A lot of volatility during power hour on Wednesday. So, and then Thursday, we have the building permits for the month of November. We have the initial jobless claims, which is our unemployment report. And then we have the Philadelphia Fed Manufacturing Index, all taking place 1 hour before the stock market opens on Thursday. And so we have the building permits, which previously on October was 1.6 million. Looks like they're thinking it's probably going to be about the same for November, you know, about 1.66 rather than 1.65, so it could be a little higher. Unemployment report was down last week quite a bit, 184,000, which I think it broke another record, which typically when it does break another record like that, it usually bounces back up a little bit. So it looks like they have the forecast kind of set for that. I think as we're getting closer and closer to the holidays, I think we could possibly see it still around there, 185, 186, maybe 190. I think we could be around here, but possibly even more. If as long as we can meet or beat this, we're good. We'll I think we'll see some, you know, pretty decent bullish characteristics Thursday morning. But if we can even beat the previous report, we should be pretty green for the rest of the day. But as we get closer to Friday, triple witching day, I'm pretty sure Thursday is going to end in the red. Do not be optimistic. Just plan ahead. Just be prepared. It could end in the green, but most likely Thursday is going to end in the red. I'm going to pull up a chart here really quick here. Not a chart, but a calendar.
So I use these every year. I'm still waiting for the 2022 calendar, but this is a calendar of stock market, certain stock market events. I use it for like holidays. That way I know what days the stock market's closed. Everything would be highlighted in purple. So we're in December. So the stock market's going to be closed on December 24th for the holidays. But the 17th though, that's this Friday's triple witching day. That's the standard expiration date for equities, equity index, ETFs, ETNs, stock options, all kinds of things. That is a very, very bearish day. Where the orange day is the last day to trade expiring standard AM settled equity index options. So that can very well provide a lot of bearish characteristics as well. So even if Thursday opens in the green, do not be optimistic that it will stay green towards the end of the day, because most likely it will not. It's going to fall. And so maybe even the morning, sometime early in the morning, maybe a good time to start buying puts on Thursday. And then and then the 17th, most likely things will open in the red. If it doesn't, just hold a little bit, and because it could provide you a little bit of a false signal, because it's going to be pretty bloody. It's going to be very brutal for a lot of investors. We're going to see a lot of people crying, hurting, and whatnot. But just plan ahead, be prepared that this weekend is going to be very, very bearish. This happens. So the triple witching day happens 4 times a year at the third Friday at the end of every quarter. So that's March 19th. June 18th, September 17th, December 17th. Every time I send these warnings out, it happens every time just like clockwork. Whether people want to disagree with me or not, but it only takes the one time, and then they're a firm believer in this. But once the 2022 calendar comes out, I'll be able to post this. I'll share it with you guys, that way you have it. But I'm hoping I can get it here pretty soon. But it's pretty neat. You can also Google, the 2022 stock market calendar, and you should find something, similar to this. But this is a pretty good one. Let's go back to the web browser here, as we're continuing to plan ahead. Now you can also click on the next following week. So this is going to be the Christmas week. So again, we always want to look at this regularly, because they could always add more information to this. So looks like Monday, Tuesday, there isn't really anything scheduled for that week. But Wednesday, we have the GDP quarterly report. So again, this will have a very big impact on the stock market. You can see that the previous quarter for the second quarter was 2.1%, which was a little down than its forecast amount, but now it's forecast for the third quarter to be at 6.6%. That is huge difference between. So Wednesday should definitely provide some very good bullish characteristics, as well as the existing home sales, which is used homes, is going to be very, very high as well, where the previous report for the month of October was 6.3 million, where it's forecast to be 6.48 million. And so as we get closer and closer to the end of the year, a lot of people are trying to hurry to buy their home to secure a low interest rate, as well as vehicles. People are trying to secure all these things before the end of the year. And then Thursday, we have the core durable goods orders for the month over month for November. And then the new home sales will be reported. And then Friday, again, Christmas, the stock market's closed. So the only thing that's going to be open is cryptocurrency. So a lot of people are probably selling their stocks. They're going to start pumping up crypto, because that's the only thing that's going to be active. So I would say this weekend, we could see some pretty good surges in a lot of cryptocurrency. So we'll need to kind of take a look at that. So economic report, hopefully a lot of this stuff makes sense. We always go over this every Sunday, and so we'll take a look at next week and see how that changes as well. But just be sure to download the app to your phone, because it really does provide very valuable alerts and information on this, as well as the U.S. futures and news and all kinds of stuff. And so now the second thing that will have a pretty big impact on the stock market, but not so much the entire system, but the segments of the system is going to be the release earnings. And every Saturday, I'll post in our group the top 10 scheduled release earnings, and that'll be in our featured or our announcements area. And so every Saturday morning, I'll post it, which you can find right down. Oh wait, where am I at here? Did I pass it here? Or no, it was on the top. I'm sure I posted it on here. Maybe I forgot to pin it in our announcement area. I think I did. All right, hold on here. Wait. Oh man, let's go somewhere else here. So a lot of this information I do get from the Earning Whisperer. So let's go there. I posted it, I just forgot to pin it to the top. But so this is the schedule for the most anticipated release earnings. And so we have Monday, Tuesday, Wednesday, Thursday, Friday, and then we'll have the top 10 listed right here. So Adobe is the most anticipated release earning for this week, followed by Fedex, Hexo, Accenture, Darden Restaurants, Toro, CleanSpark, Jabil, Worthington Industries, and the ABM Industries. Now let's go back to our group. And then every either Saturday evening or Sunday morning, I'll post the top 10s analysis in the group. So where the ABM, which is confirmed to release their earnings Wednesday morning before the stock market opens, the company has a 62% expecting an earnings beat. Now, when we look at this regularly, 65, 66, 67% is about average, when we're looking at everything. And so if it's slightly below that, it's slightly below average. If it's above that, then it's slightly above average. But this one is kind of hovering around the average area, just maybe a little bit below. Then we have the Worthington Industries, which is confirmed to release their earnings report Thursday morning before the stock market opens. The company earnings release has a 60% expecting an earnings beat, which is just slightly below average. Then we have the Jabil, or the JBL, which is scheduled to release their earnings Thursday morning before the stock market opens. The company's earning release has a 74% expecting an earnings beat, which is way above average. 74%. This is one out of the three that have basically a high percentage chance that they're going to beat their earnings and the stock's going to go up. So 74%, I believe that would put it the second most or the highest percentage for the next to CleanSpark, where CleanSpark is scheduled to release their earnings report Tuesday after the stock market closes. The company's earnings has a 73% expecting an earnings beat, which is just one more percentage, or 1% below the Jabil. So Jabil is definitely the second most. CleanSpark's going to be the third, where Adobe, which we'll get to, will be the most. Basically, Adobe has the highest percentage chance that they're going to beat their earnings. But Toro Company has they'll be confirmed to release their earnings Wednesday morning before the stock market opens. But the company has a 51% expecting an earnings beat, which is not good. 50-50, that's not good at all. Now, a lot of times I'll post clues, using these little emojis, kind of pinpointing, highlighting exactly what the odds are, but also in the images. A lot of times we can get some clues on what the company is, what they do, just by looking at it. Toro, I would have no idea what this company is if I didn't see this image, but obviously they're a manufacturer
Question here, Carlos, if possible, regarding Adobe and the release dates, right during the interest reports coming up. So are you expecting these, however the percentage is high, is going to be bullish or bearish?
So usually if it's high, most likely it's going to be bullish. If the lower the number, it will most likely be bearish.
Yeah, even we have bad news next week about the reports coming up.
Now, those reports, well, the economic reports could provide us some great buying opportunities, especially if they ended up being bearish. That could provide us an opportunity to buy low if the if we knew the stock was going to go up. Let's go up to Adobe really quick. So Adobe is scheduled to release their earnings report on Thursday morning before the stock market opens. But they have a 78% expecting an earnings beat. That's almost 80%. That's when we convert that into odds. That's 4 out of 5 4 out of 5 odds that the stock's going to beat their earnings and the stock's going to go up. But by knowing what the week is going to be like, if the first half of the week is going to be bullish, then we want to probably get in a little sooner. But if the first week is going to be bearish, then we want to wait for maybe the bottom point so we can buy at the lowest point. And then as it gets closer to...
Could you bring the graph for Adobe a little bit, if possible?
Adobe, yeah, let's take a look at Adobe on the graph here. Let's see where Adobe is using the daily chart. So it's very interesting here. Pattern still kind of looks like a double top pattern. Don't like that, but that means it could easily come down. But as it gets manipulated by news or earnings, it can easily change the direction of the stock. But by looking closer, though, other than looking at the pattern, it does provide kind of like a fresh buying signal. We can see that the price line has cut through all 3 moving average lines, though the moving average lines haven't yet crossed over each other, providing us our last final buying signal. But
you update the interval to a little bit slower, like 30-minute or 5-minute, to see more dips and highs, so to see the buying and selling signals for the signal, for this shape.
Yeah, so if we did the 30 minutes, you can kind of see the shape a little better here. But for the recent activity, it's uptrending. It's going up. So the buying signal was right in here around your 635. It's uptrending, and it may continue to trend up. It has not yet provided a fresh sell signal according to the 30-minute chart. If I switch over to the 5-minute chart, that's when it provides a little bit more signals, but it definitely provided a fresh buy signal here because the price line is now above the 3 moving average lines. So we'll have to see how that continues tomorrow morning.
Thanks, Carlos.
Yeah. Let's go back to the earnings here, and let's take a look at the next one. Was Darden Restaurant. Somebody in our chat room mentioned that Red Lobster is no longer part of that. So eventually I'll have to change this. But by looking at Darden Restaurants, typically the average person would not know what restaurants these are, but by looking at this, now we have Olive Garden on there and so on. Now we're like, okay, this is one of those chain, restaurant companies that own and operate a lot of very well-known restaurants. And so Darden Restaurants is expected to release their earnings Friday morning before the stock market opens. And the company's earning release has a 59% expecting an earnings beat. Now, just because these earnings releases are being reported now towards the end of the year, we have to remind ourselves these reports are for the third quarter. Now, the third quarter of this year was July, August, and September. So, that is when a lot of people are probably on vacation, traveling, a lot of stuff, is going on. So a lot of people, I think, are doing a lot of restaurants and stuff too at this time. But so the number does definitely seem to be a little lower than average, but we just have to remind ourselves this is for third quarter, and when was the third quarter? And because a lot of times people will think that the earning releases may be for the fourth quarter. So Accenture is confirmed to report their earnings during Thursday morning before the stock market opens. The company's earning release has a 66% expecting an earnings beat, which is right about average. Now, Hexo is confirmed to release their earnings report on Tuesday morning before the stock market opens. The company's earnings release has a 49% expecting an earnings beat, which is probably one of the lowest percentages out of any of these release earnings. Now, Fedex is right here. Fedex is expected to release their earnings Thursday after the stock market closes. The company's earning release has a 65% expecting an earnings beat, which again, with social media was like, how come it's so low? It should be higher, because this is third quarter. That's July, August, September, when everybody's on vacation. They're not so much ordering things on Amazon and stuff up until the fourth quarter, which is going to be your October, November, December. That's when people are shopping heavily online. That's when FedEx is pulling their hair out, because they need help. They're trying to hire outside their company. They're trying to get UPS to help them, or all kinds of other stuff. So this is fourth quarter is when FedEx is really going to shine. But
hey, Carlos, I had a question.
Yeah.
In terms of earnings, like our earnings, do they come in consistently every, the same day for each company consistently throughout the year, or do they vary? Like, let's say, all right, third quarter, FedEx is set to release their earnings on the 16th, or is it consistently the 16th, or does it change?
It changes because they all kind of have to apply for it. A lot of times, the Wall Street or other sources don't exactly know when these are going to be reported until at least usually around 30 days before the release earnings, because they all kind of have to sign up for the schedule. Kind of like, if you're making a doctor's appointment or an oil change appointment, it's like first come, first serve.
Okay.
But so they will be on different days, it will be on different times, but they do like to strategize what time of the week or what day of the week. So a lot of times you'll see the small cap companies, their earnings are usually released on a Monday or a Friday, but the higher market cap companies are going to be more on a Tuesday, Wednesday, Thursday, and typically after the stock market closes. The medium type cap companies will usually release their earnings Tuesday, Wednesday, Thursday, but normally in the mornings. So they do have their strategy of when it will be released, but it's not usually on the same day every year or every quarter.
Okay. So like, for instance, not to forecast or project the future, but let's say, quarter one, when FedEx releases their earnings again, maybe they're going to be a higher percentage because of all the buying that happened in the fourth quarter 2021.
Exactly. Absolutely. Because you will definitely see that. Now, a lot of times when I post things in here, usually when I have a ticker in here, I'll post it with the little pound symbol or whatever you call it, hashtag, whatever. So pound FDX. So if I go to like the little search bar, I could do that, FDX. Now I can look at maybe past, the past things. So that was just posted the other day. Here is from September 13th. They were 78%. So this was for the second quarter. So 78% was very, very high. So, and that's where you can really see maybe the past difference. Let's see if we can find the first quarter, or no, fourth quarter. Let's go here, June. Wait, it's June. That's weird. Why are there two? Here's December. That was last year, which is weird because they had an 83% expecting the earnings beat. March. Okay, so this was earlier this year. This was March 14th for FedEx. for the fourth quarters. And so this is what I would expect for exactly what you were saying. As we go into the first quarter of next quarter, we should see a much higher percentage expecting an earnings beats. 79%, 84%, something like that.
Right.
Carlos, if we took the graph for this report, 78%, what can we see what's happened for this share at that time? To make an expectation, what is going to happen this week?
For Fedex?
Yes. Yeah, you said that it was like 80 something last year.
Oh, yeah. Well, like the percentage wise and everything. Okay.
Yeah.
Let's see. We have the earnings here. Let's see, that was. Okay. So when we look at that earnings report right here, when it was 79%, look what happened. We had a massive amount of buying volume right here. But just days prior to that, which people knew that this was going to be high, you can see that it provided a little buying signal here. There was a little bit of dip right in here in the beginning of March. But yeah, March. And then so right before the earnings report, it was trending upwards. And then after the earnings report, it just continued the momentum all the way up. It kind of fumbled a little bit right here in April, but it continued. Most likely the whole system was manipulated or whatever, creating some good buying opportunities, but it continued the momentum the rest of the way up to about $315 from when it was down here about $255. So that's a big difference. And so I would expect the same type of algorithm as what we're seeing now. And so with this area here, we're kind of seeing the same thing with our market, or we're kind of seeing that double top pattern where we see these 2 points here. And then in October, same thing. We're right here right now. And then as we enter the triple witching, and then towards the end of the year, the holiday, the whole system, the stock market is going to come down towards the end of the year. And then as the yearly economic reports come out, the stock market's still kind of fumble. They're going to struggle throughout January and then February. And then as we get closer to March, then that's when we're starting. Most of the yearly economic reports are done, and now we're starting to look ahead, waiting for the springtime. We can start buying low during March. Is usually the best time to buy your long-term stocks, and then usually after the beginning of March, things start to go upwards for the majority of the year. It just depends on the stock, but it looks like Fedex may be kind of around where it needs to be. It's kind of ranging, right here in the middle, around 260, I guess. It will go down to 240, come up to about 280-ish, 315 at the most. But we should see the exact same type of characteristics.
Okay, thanks, Carlos.
Absolutely. So that's a good trick or tip that's best to utilize if you're trying to find any of my previous information. Always put that little hashtag under the search part there, and that way you can find any of my stuff that I may have posted in the past. But everything that I post is usually saved in the announcements featured area. So once we go over all of the economic reports and earnings, then there's one last bit of something that we need to do is we need to look at the investing.com's top 5 things to watch in the markets ahead. And so this report is typically posted every Sunday morning. So when we click on it, it'll take us to that article, because what we want to do is we want to try to find something that we may have missed. We want to make sure we're all on the same page, where the Federal Reserve, the Bank of England, and the European Central Bank are just some of the global central banks gearing up for their final meetings of the year in the coming week against a background of spiking inflation and Omicron woes. The United States stocks are back at record highs, but there is still the potential of a renewed volatility after last week's sell-off. Meanwhile, economic data, including reports on producer prices and retail sales will be in the spotlight, with the Fed moving closer to hiking rates. Here's what you need to know to start your week. So number one is the Fed to discuss faster taper. So where the Fed will hold its final meeting of the year on Tuesday and Wednesday. Chair Jerome Powell and his colleagues are expected to discuss accelerating the wind down of the central bank's $120 billion a month pandemic era asset purchase program. So this again is going to provide very bearish characteristics. In November, the Fed began tapering its stimulus program at a pace that would have put it on track to complete the wind down by mid-2022. Analysts think if the Fed accelerates the taper, the process could end by March, clearing the way for an expected 2-rate hike in 2022. Investors will also be on the lookout for any signs that the Fed is growing more concerned about inflation, which Powell said can no longer be described as transitory. Data on the Friday showed that the consumer prices rose at the highest rate in almost 4 decades last month, underlying expectations for higher rates. Now, number two is the same. I think the Bank of England and whatnot will announce their final monetary policy decisions of the year within 45 minutes of each other on Thursday, and both are potentially market moving. Uncertainty over the Omicron COVID-19 variant means that the Bank of England is now expected to hold off on hiking rates until February. Jobs and inflation data will provide United Kingdom policymakers with final insight into the strength of the economy ahead of Thursday's meeting, with inflation forecast to reach its highest level in a decade. The ECB expected to announce that its 1.8 or 1.85 trillion pandemic stimulus scheme will end in March. The fourth wave of the pandemic and new Omicron variant have clouded the outlook for the Eurozone economy. Now, this could easily affect, now usually what happens in Europe doesn't really affect us so much, but what's going on over there is definitely, could easily affect our market. So that's why it's on number two. Number three is the United States economic data. The United States is due to release data on producer price inflation on Tuesday, which will be the highest of the economic calendar, which should provide some pretty good bullish characteristics. The high rate of inflation is being driven primarily by supply chain bottlenecks, with those issues showing that little sign of easing and companies raising wages as the compete for scarce workers. High inflation could persist well into 2022, where the labor market data on Friday showed that consumer prices surged 6.8% year over year in November, but the highest reading in more than 39 years. Meanwhile, figures on retail sales are due out on Wednesday, followed by the data on industrial production and initial jobless claims on Thursday. Then number four is the market volatility. United States equities are back at record highs following a sell-off triggered by concerns over the Omicron variant and the prospect of faster tapering. But markets could be freshly rolled by indications that the Fed is growing more worried about inflation. Signs of a more aggressive rate hike path to the dot plot projection of rates could also provoke renewed volatility. Investors are also eager to hear the Fed's view of the Omicron variant's potential impact on economic growth or inflation. The Mana, whatever that is, senior investment strategist at Edward Jones told Reuters that the Fed meeting could bring more clarity to investors after an upsurge of volatility in recent weeks. It feels like the markets has climbed two walls of worry already, Omicron and a path of the Fed, she said. I do think over the next couple of weeks, we will get a little bit more certainty on both fronts. Now, the fifth one is the Bank of Japan. I don't think this may have as big of an impact on the on our stock market system, but it is number 5 that'll have, you know, some kind of an impact, but not as much as these other 4. Well, the Bank of Japan is concluded its 2-day policy meeting on Friday and looks to maintain ultra loose monetary policy, but debate whether to extend its emergency pandemic relief program beyond the current planned end date of March 2022. Turkey's central bank meets on Thursday to decide whether to cut interest rates as demanded by President Recap, whatever his name is, in the face of higher inflation currently running at more than 21%. Wow. And a weaker, whatever that is there. Central banks in Switzerland, Russia, Hungary, and also meeting during the week with rate hikes, the latter 2 weeks on the cards. So again, as we go into 2022, that's going to be the year for banks. You know, so if you're a long-term investor, you know, as we start getting a lot of these dips for the next several weeks or the next several months, it would be a great time to start buying into bank stocks. And so that is, like I said, this information is just very, very critical, very important to go over. Now let's go over some stocks and stock options. And so again, as we're talking more and more volatility, I do a lot of straddling. Straddling again is where we buy both calls and puts. It's very, very effective, but it's still very important, whether you're in this options or not, to really look at options activity. And so there's a free website you can go to. It's called barchart.com. This is where we can look at activity for options. And so if we go to barchart.com, we want to click on the menu and then click on options. And then the first thing we want to see is the most active options, because this will sum up the entire options system into one page. And so as we're looking at this point in time on Sunday, December 12th, this information is going to be from Friday right at close. So on Friday, Apple dominated the top of this list. They closed at $179.45, but they have a huge amount of volume, 2.7 million in options volume, which was double the amount of Ford Motor Company. Out of this amount of volume, we have 66.7% are buying calls, betting that the stock's going to keep going up either for that day as well as possibly even the next trading day, where 33% of this volume is betting against the stock, betting that the stock's going to go down either that day or possibly even the next day. And so where Ford Motor Company is on the second place on this list, which is not normally on the second. It's usually down here in the middle or the bottom. But out of this, a massive amount of highly unusual volume for Ford Motor Company, more than 78% are betting that this stock's going to keep going up, where 21% are betting that this stock's going to go down. So you're not just getting people's feedback or their emotions or whatever, you're seeing where they're putting their money. So that's another thing that a lot of professional traders and investors say. They say, follow the money. This is it. We're seeing where the money's going. So they're saying that Ford Motor Company is going to go up. And we can see out of this entire first page here that Ford Motor Company holds the highest percentage call ratio out of everything else, where Microsoft looking like the second place. Now, when you look at this stuff regularly on a daily basis, you know what's normally on here and what's not normally on here and where it's normally at. Apple's usually on the top of this list because Apple is very commonly used to trade or to day trade and to swing trade. It's very popular. It doesn't move very much, but when it does move, like I said, every 1% is like a 50% gain or loss in the options world. And so, plus Apple has a very smooth algorithm when it comes to its moving averages. We can really identify it very, very easy, much easier than anything else. And so that's why it's always on the top. It's very, very popular because of all that. But when you see something that's not normally on here, we need to consider that unusual activity, especially when it has a very high percentage, whether it's a call or a put. Consider that very unusual activity, and we need to put that on our watch list and see what's going on and see if we could take advantage of the situation. So this is very, very critical to look at on a daily basis. Now this will begin to update 1 hour after the stock market opens. So that's the perfect time to start looking at this. This is like your watch list. This is like your assistant telling you this is what you need to watch. And the prices change by the second. The change dollar amount changes by the second, as well as the percentage change. But at every 15 minutes after you watch this, after 1 hour after the stock market opens, you'll want to refresh it. It will try to refresh it on its own, but every 15 minutes after the hour, you'll want to click the refresh button, and you may see the order change and the volume options will change. You may see things that will kind of begin to fall off the list. You may see things that were on the bottom of this list are now becoming towards the top of this list. There's a lot of other events and situations that I've seen this happen, like when GameStop and AMC was down to like $3 or $5 a share. I watched those stocks hit the top, towards the top of this list. And I knew, and it had like an 80-90% call ratio. I knew something was up. Something was flying underneath the radar. Nothing was happening yet. It wasn't on the news yet, and I knew that's something's going on, flying under the radar. It's time to jump on board because something was going to happen. And then boom, all of a sudden, GameStop starts to surge $100, $200, $400 because and then all of a sudden it started hitting the news. And but this is where we can try to find things that are flying underneath the radar. And that way we can get in, we can get out and secure our gains on certain things that are becoming very, very active, showing unusual activity. Now, if you're starting to see maybe things that are plunging, like AMC, maybe it's down, 7%, but maybe it has a high call ratio. I kind of start to think that maybe people that are a lot of new investors that are optimistic and maybe they're holding and they're trying to lower their average cost. And so, but you want to go with the flow. If it has a high call percentage and it's in the green, most likely there's a lot of more momentum going, and it's going to keep going up the next day. But you definitely don't want to, get involved in people that are trying to lower their average cost.
Also, if it's a strong stock too, like Apple and Ford are stronger in essence than AMC, which is obviously manipulated.
Correct. Yeah, and that's why it's very important to know about manipulation, know it's there, be a part of it, thank them, whatever because a CEO like Elon Musk can easily manipulate it from a tweet, or the hedge fund companies can easily manipulate things, news media, politicians, they all do it. But we have to just identify what's manipulating and what's manipulation and what's not, and let's ride that wave. It's kind of like that thing, you can't bullshit a bullshitter. You just have to know what they're doing, even though they're not saying it, because they can't can't flat out and say what they're doing, but they can provide these little clues and little hints, but we just have to be able to identify those, and it takes a little time. It just takes experience and whatnot. But
Carlos, I had a question. Why are all these implied volatility percentages different? Is there any way we can draw a correlation between the call percentage, put percentage, and implied volatility, and how does that affect our decision?
Yeah, and so just like the release earnings, how when we look at those, the average usually was about 65%. It's very similar to the calls. Calls typically have a 65% average call ratio, where the put ratio is usually around 35%. So this call ratio versus put with Apple is very, very average. The Ford Motor Company, that is not average. This is very heavy on the call side. Tesla, that's usually pretty standard for Tesla. Tesla's usually 50-50, but still, but when we're looking at the majority of other stocks, the call percentage on Tesla is very low. But when we start to see 50-50, that could be because maybe people are straddling. Because even though AMC is down, 7%, let's take a look at something here. Or even, Apple, or let's say AMC. AMC is down quite a bit. I'm going to see if I can pull up their most active stuff. AMC, I think, has a pretty high depreciation rate. And so, but we can see that even though AMC dropped a lot, almost, over 6%, if we were to straddle, because that's what it looks like right here, we have almost 50-50, 47% calls, 52% puts. If you lost, let's say 61% on your calls, but you gained 144%, you didn't really lose. You're just trying to cover your bases as an insurance play, because volatility is right around the corner. We're going to see stocks that are going to surge. We're going to see stocks that are going to plunge. But if we could just not be using the hope system or being optimistic, we need to be on both sides. And it doesn't mean that we have to sell them at the same time. We can sell them at different times to maximize our gains and to minimize our losses. And that's where I highly recommend going into the next several weeks. Let's just straddle. Let's just play it safe. Let's make a lot of money doing it. Because the only time that you'll lose money with straddling is if you just kept holding day after day and the stock isn't moving in any direction. You're going to suffer time decay and time depreciation on both sides because they're not doing anything, and you're getting closer and closer to the expiration. So you want to be pretty active, get in, get out, sell, and try to buy at the money or in the money. Try not to buy out of the money, or if you do buy out of the money, try to be very close to the money, meaning the share price. If you're too far out of the money, being too far away, your share price is this and your strike price is 10-20% away, you're really going to suffer a lot of time decay and depreciation, and sometimes the system doesn't think it's going to make it to that point, so it's going to suffer even more time depreciation. Versus if you bought right at the if you bought your strike price at the share price or even in it, then you're not going to hardly suffer any time depreciation because you're already in it. It'll be more expensive, but it'll be worth it because you're just not going to suffer as much depreciation.
So Carlos, I had a question. So I just pulled up Robinhood and I pulled up Ford, and I know that when I buy a call, the in the money call would be $21, $21.50, because the share price is $21.57. If I was to buy a put, which way would be in the money on a put?
So if it's currently at I don't know what it's doing after hours, but it's currently at $21.45. And so this is the most active calls for Ford Motor Company. This one here is the most active puts for Ford Motor Company. So even though Ford was up 9%, this $22.50 strike price gained 733% one day. I mean, especially all these other ones, 4,400%. My gosh. So even if you, like I said, if you lost 85%, 99%, you gained 4,000%. I meing, this is a no-brainer. But looking at these,
no, but Carlos, my question is, like, if I was going to order a put, buying a put, and the strike price is $21.45, would I need to buy a put at $22, or I need to buy a put at $21? Which one of those is in the money?
So in the money for a put would be $22, and a call would be $21.
Okay, so for a put, in the money is a price above a strike price above the share price.
Correct.
Okay, thank you.
So, and that's where we're seeing the most active call right here is $21, because now the share price is already in the money, because it has already passed it. And we can see that the $21 are the two most highly active individual options for the calls. And then the puts, though we don't see a 22 on here yet, but most likely we will on Monday. But
so at this point where we see this surge in the call and we go over there and we're like, oh, it's obviously too late to buy the call then, right? We're like, oh, we're too late to the party, right? So what we do then is maybe reassess, look at the EMAs, and hopefully find a buy signal for maybe a put. Maybe it's going to go into a downtrend.
Yeah.
Okay.
Yeah, because using the moving averages, once it provides you your normal sell signal, that's the time to buy a put, because then the stock's going to most likely go down, especially after the moving average lines crosses over each other. And that's where we can really buy and sell or buy our calls and puts at different times, as well as to sell them at different times. It doesn't have to be at the same time, but it's safer to do it that way. But it does require a little bit more experience and with the moving averages to be able to sell at different times. And that way we can maximize your gains and minimize your losses. But this website that I'm using to pull the individual most active stocks or calls and puts for an individual stock option is through NASDAQ. And so if you go to Google, you can Google either the ticker name followed by NASDAQ most active options. It'll take you right to that page. But once you get familiar with this page and the link, all you have to do is just change the ticker code in the URL address to anything. So Apple, you just type in Apple for the ticker, click enter, and it refreshes to that ticker on the NASDAQ website. Now, it doesn't show the expiration on here, but you would have to click on it to view the expiration to see if it's still active or if it's expired. So if you click on it, it'll pull up the next page and it'll let you know if it's expired or not. So if it is expired, you want to avoid it and keep looking at other things. And that's normally what we'll see on a Friday or Saturday or Sunday. But if we start looking at this on a Monday, we're not going to see anything that is expired. So everything will be very active. Now, going back to the bar chart website, as we were looking at the most active stock options, the next side on the options menu is the options volume leaders. So we'll click on that, and this will show the most highly active individual calls and puts out of the entire system. So, but DTE, that's the number of days until the option expires. So as we're looking at this on a Friday, Saturday, or Sunday, we need to try to avoid looking at the zeros, because now, this being on a Sunday, it's invalid or it's expired. It's no longer, it's not going to show up on there tomorrow. It's going to disappear. So the next most active call that's still current is this $180 call strike price that expires this Friday on December 17th. These are the current values. And then we have the option value and then the open interest. Now, if you're new to options, open interest is like an accumulation of volume previously to this current trading day of Friday. So this volume, as we go into Monday tomorrow, is going to merge itself with the open interest here. Now, if we look at this, we can see that the open interest prior from Friday was 59,000, almost 60,000. So if we look at this like a volume, we can see that maybe less than 60,000 people are maybe holding this, but now we have a fresh 122 people that bought into it. And because it's up and over the open interest, that is unusual activity, because it's way higher than the open interest, showing a lot more interest, and it's showing a lot more buying unusual activity. Unlike something else that may be backwards, like let's see if I can find something here. We'll find something later. But if it's vice versa, if the open interest is higher than the volume, then we don't always know if that volume is selling activity, or it could be a 50-50, it could be a blend. But as long as the options volume exceeds over the open interest, that is a massive amount of pure buying, unusual activity. So just make sure you have a note of that. So the second most active individual call and put is this Ford Motor Company call, $21. The second place out of the entire system. That it also has the same expiration date with a very large amount of volume that exceeds over the open interest. And then the next one is another Apple at $175 call strike price. There's another Apple, $177.50. Then we have Apple, another Ford. Then we have a put on Apple, $170. So there could be some straddling activity there. as an insurance play. So it looks like mostly it's just the Apple and Ford right now going into Monday. So the next thing we want to do on the options menu is click on unusual options activity, just to see if there's any other unusual things that we didn't detect. And so by here, we want to see the biggest difference between volume and open interest, because it's going to find open interest that had really no interest, and all of a sudden it has some kind of interest all of a sudden. But the biggest one is this Ford Motor Company one at $22.50 strike price that is currently active, that expires this Friday. And so, but we do see some a lot of great positive, bullish, optimism with this stock. And so, even if you're not into stock options, you can still look at this as a form of what people are buying, and should you buy shares in that company. So this is really good to know. And then that last one is the straddling stuff. So straddling and strangling, we want to click on all four, and I'm going to show you what we need to detect to find unusual straddling activity. Is we need to find multiple things of the same stock. And so we have ARDX going down. I only see that one. Fedex is right there. We were talking about Fedex. Looks like people are starting to maybe straddle a little bit there. Hexo, talked about Hexo regarding this week. Robinhood, we got Nike. But I see two Pfizers so far. We have MU. What is that? MU is that the micro? I think that might be the micron. I think. So we got two of those, and Alibaba. So we have a couple of. I wish we have a little bit more. The more we see of the same thing, the more unusual, the more active that I think that people are straddling. So far we see three on there. Then we click on the next one, long straddle. Looking for anything that multiple of the same things. We have a couple, I think Nokia's, AMC, Palatar Technologies. So, but I'm only seeing, well, we see more of the AMC. There's four, 1, 2, 3, 4 of the AMC, and 1, 2, 3 of the Palatar Technologies, and only 2 of the Nokia.
Hey Carlos, I have a question. Difference between long straddle and short straddle, is it time frame or is it direction?
It's a time frame, but we want to know everything. We want to know it all. We want to know where people are putting their money, because again, the pros say follow the money. So the only way we're going to follow it is to be able to see it. And so, but the difference between a straddle and a strangle is that a straddle is the calls and the puts are the same strike price. The strangle is when the calls and the puts are different strike prices. Because maybe, like I said, maybe like we were looking at Ford Motor Company is what, $21.50. Some people may get a $22 call strike price and a $21 put strike price, because they're different. They're not the same strike price, they're different. But the concept is the same strategy. They're betting the stocks can go down and up. They're just betting a little differently. But they're all the same strategy though. So the next one, we want to click on the short strangle and try to identify any of the same multiple stuff. So by looking at it, now we see Adobe's on here, which we've been talking about Adobe going into this week with their earning releases. We see 1, 2, 3, 4, 5, 6. Now, so far, this holds the majority of the unusual straddling activity that we're seeing. Next one, we see the Robinhood here. We got 1, 2, 3, 4, 5. So far, the Robinhood is now holding second place. Looks like there's another Fedex here. We got 1, 2 Fedexes, where we had another Fedex on another page. And then we'll go to long strangle and see if we can find anything on this. Now, a lot of times, so we see a lot of AMC. So AMC dominates this list. So AMC so far is the most heavily straddled or activity that we're seeing. A lot of people are doing, and by looking at the majority, remember we saw 50-50 ratio. So obviously people are betting straddling on AMC, and then going into our earnings releases, looks like Adobe and Fedex. but I don't recommend straddling release earnings because the IV, there's something what's called an implied volatility crush, or also known as an IV crush, which the news can affect the both sides of the option, your calls and puts, and can devalue it just from news, just overnight. And so when you're doing options for release earnings, you got to be right, and you pretty much got to pick one or the other. But it's got to be a lottery play. Whatever you invest into a lottery play, you have to know that that money could potentially be gone. So don't, if it's gone, you just don't worry about it. Don't invest heavily into lottery plays. And that's what a lot of these earning releases are. It's best to wait until the earning is released and to adapt to the situation, whether the stock plunges or it surges, and then play after and as well as before. So that is the options information that I have here. I think that is it. I don't have anything else other than that. Anybody have any questions before we close? Everything makes sense? Good. Everything makes sense. That's looking good. Good. The more you guys learn, the more you earn. If you guys ever have any questions, please, you can message me directly on Facebook Messenger or chat in our chat room within our group. Also, if you guys like books, we have a phenomenal library in our Facebook group. If you go to our group, click on the little magnifying glass, type in stock market library. So type that in. The first thing that comes up, you should see my post from back in January 11th, the stock market Bible. So you click on that, this will pop up. It'll provide you a lot of reading material, and they're all PDFs. You can download it to your phone, your computer, your book reader, your tablet. Everything's right here. If you need some reading material, day trading for dummies, whatever, you can click on it. It'll download. And then that way you can pull it up, and plus there's categories up here: trading options trading collection. You can get into there and pull those as well. So thank you guys for coming in. We'll do this every Sunday. Stay safe, make good choices, and let's make a lot of money this week. Thank you guys.
Thank you so much, Carlos.
Thanks, Carlos.
Later.
Talk soon.
Bye-bye.